Okay, so this is the direct write-off method. All right, so we'll get to what that means in a second. But anytime you make a sale on account, you're gonna, instead of debiting cash, you're not getting cash yet, so you debit accounts receivable and you credit sales. That's the um, entry you make when you make a sale on an account. Now, if this involves merchandise, you have to record the sale entry and adjust the merchandise. So anytime you have a sale, we're not going to make the full $77,000 off that sale. We have some costs that we need to subtract out on the income statement. And that cost is the cost of the merchandise we sold. So you're going to debit cost of merchandise sold. It's like an expense. Okay. And then you have to adjust your inventory. So you're always going to credit the inventory account. So this is going to adjust the income statement. It's going to make sales go down to get your gross profit. And this credit to inventory is going to adjust your inventory on the balance sheet because we are selling this, so we need to decrease our inventory account. Now, for July 7th, we received $30,800. So we're going to debit cash because that's how much we're getting. But the remainder of the $77,000, the remainder we're not going to collect. Since this is direct write-off, we're going to go ahead and take it off, the full amount off the accounts receivable. So it's almost like they paid us with the direct write-off method. Okay, we're going to credit their full amount here. And then the remainder that they couldn't pay, we're going to write it off to the expense account. Okay, that's the direct write-off method. You just record it as a bad debt expense when they don't pay. We don't have an allowance account. Okay, but then they decided that they're going to reinstate that accounts receivable. So anytime you reinstate it, you just reverse this entry. You're going to debit accounts receivable. So now we're saying, hey, they're going to pay us and they still owe us. And you're going to take the bad debt expense back off. So you're going to credit it. All right, and then when they pay, now you can do it just like you normally would. You're going to debit cash and you're going to credit their accounts receivable. The difference in up here, when we credited that $46,200 included in that accounts receivable, it looks like that they paid when we credit that, but actually we didn't get cash, we got an expense. So now before they can pay on their accounts receivable, we have to record that accounts receivable. We have to put it back on the balance sheet. That way we can take it off the balance sheet down here at the last entry. Hopefully this will help you understand a little bit more about what's going on, but just let me know if you have any questions.